All right, so let's talk about this $4 trillion gone poof from the U.S. stock market
Wow.
in just 20 days.
That's a lot.
That is a huge amount of money, to put that into perspective. That's basically like India's entire GDP just wiped out in less than 3 weeks.
It's a staggering figure.
Yeah, so that's kind of what we're diving deep into today, the rising fears of a U.S. recession.
Makes sense.
Especially based on, all this recent market turmoil and economic indicators all pointing in that direction. We've been looking closely at this analysis from the Think School YouTube channel.
Oh, yeah, I've seen them.
Specifically their video called Recession Fears in America Again, India in Trouble. Economic case study.
It's ominous.
Yeah, so what we're going to try to do today is really pinpoint those key signals that suggest a U.S. recession might be on the horizon.
Right.
And then how that could potentially impact India. And really, most importantly, how all of this could actually impact you, the listener, and what you can do to kind of weather the storm.
Practical steps.
Okay.
I like it.
So, you hear the word recession all the time.
All the time.
And it's kind of like this scary word. Everyone's like, oh, no, recession. What does that even mean?
Right. It can be a bit nebulous.
Right. So the video that we were looking at actually broke it down into two definitions, like the technical definition of a recession, which is what most people think of, I think.
Yeah, 2 quarters.
Yeah, 2 straight quarters of declining GDP, which is gross domestic product.
The total value of goods and services produced in a country.
Exactly. So that's kind of the textbook definition.
Yeah, the technical one.
But then there's also something called a real recession,
Okay.
which is what the National Bureau of Economic Research, or NBER, uses, and that looks at a much broader picture.
So not just GDP numbers.
No, they look at things like unemployment, are people losing their jobs, are wages going up or down, consumer spending, are people still buying stuff, or are they tightening their belts?
Makes sense. A much more holistic view.
Yeah, and then industrial productivity, are factories and industries producing more or less,
All right. Are they scaling back?
So they look at all these factors to kind of get a
real sense.
A real sense of whether we're in a recession or not.
And what's interesting is that right now, the U.S. economy is sending mixed signals.
Yeah, it is.
GDP growth has slowed down, but it's still positive.
Right.
The job market, it's cooling off, but it's not collapsing.
Yeah.
And the stock market, well, we talked about that. It's volatile.
Yeah, a little bumpy.
And interest rates are relatively high.
Yeah. So that leads to the question, if the U.S. isn't technically in a real recession,
right,
why are people so worried about it?
Why all the panic?
Exactly. So the Think School analysis really zeroes in on this one indicator that they say has historically been very reliable in predicting recessions, and it's called the yield curve.
The yield curve? Okay, I'm
listening. So for our listeners who might not be familiar with this, what exactly is the yield curve, and why has it been such a reliable predictor in the past?
So basically, the yield curve is a graph that shows the yields on U.S. Treasury bonds across different maturities. So you've got short-term bonds, like 1-month bonds, and then you've got longer-term bonds, like 10-year bonds or even 30-year bonds.
Got it.
And a bond is essentially the government borrowing money from investors.
It's an IOU.
Yeah, and they promise to repay it with interest.
Right.
But here's the thing. The stated interest rate is fixed when the bond is first issued, but the yield can fluctuate.
Oh, so it's not just about that initial interest rate.
Right. The yield is the actual return an investor gets, and it's based on the bond's price in the market.
Okay, so if a lot of people want to buy a certain bond, its price goes up and the yield goes down.
Exactly.
And if the bond isn't popular, the price drops and the yield goes up to make it more attractive to buyers.
You got it.
Okay, so I'm following so far.
Good. So now let's talk about what this yield curve looks like in a healthy economy.
Okay.
Typically, you see an upward sloping curve. This means that investors expect a higher return for tying up their money for a longer period. So a 10-year bond would offer a higher yield than a 1-year bond.
That makes sense. More risk, more reward, right?
Precisely. Now, here's where it gets interesting. When fears of a recession start to creep in.
Okay.
Investors get nervous and they start looking for safer investments.
Like long-term government bonds.
Exactly. Those are seen as a safe haven. So demand for those bonds goes up, their prices go up, and their yields go down.
Because they're seen as less risky.
Right. At the same time, investors become less enthusiastic about holding on to short-term bonds.
Because the near future seems more uncertain.
Yeah. So demand for those bonds drops, their prices fall, and their yields go up. And when this happens, the yield curve can flatten out, or even invert.
Invert meaning?
Meaning that short-term bond yields become higher than long-term bond yields.
And that's the big warning sign?
Yes. Historically, an inverted yield curve has been a very reliable predictor of recessions.
Wow. And the Think School video pointed out that we're actually seeing some inversions in the U.S. Treasury market right now.
The yield on the 1-month Treasury bill is already higher than the yields on 6-month, 5-year, and even 10-year Treasury notes.
That's not good.
Not really. And the 3-month Treasury yield is higher than the 5- and 7-year yields.
So that's a pretty significant signal then.
It is. The video emphasizes that when the 3-month yield surpasses the 10-year yield, it's historically been a very strong indicator of an impending recession.
Oh, okay. So that's a big red flag waving.
It is.
But on top of all this, we also have those trade wars and tariffs adding to the economic unease.
Right. The whole trade war situation definitely adds another layer of complexity.
Yeah. And the video kind of traced this back to when President Trump first started imposing tariffs.
Yeah, those initial tariffs really seem to mark a turning point in market sentiment.
You know, when he first came into office, the market seemed pretty optimistic.
Yeah, there was a lot of positive momentum.
But then these tariffs, especially on goods from China, started to really impact things.
Right, and the video explained how even though the tariffs were intended to punish China, they often ended up hurting American consumers the most.
Yeah, because those costs get passed on.
Exactly. They used the example of a smartphone made in China. Let's say it costs $1,000 if a 10% tariff is slapped on it. The Chinese manufacturer might just raise the price to $1,100 to maintain their profit margin.
So the American buyer ends up paying more.
Right. It's the consumer who ultimately bears the brunt of those tariffs.
Okay, that makes sense. And then how did these tariffs affect American businesses themselves?
Well, for businesses that rely on importing materials or goods from China, those tariffs meant higher costs.
Right, which cuts into their profits.
Exactly. Their profit margins get squeezed, which can lead to lower stock prices, and that makes investors nervous.
And that can trigger those market sell-offs that we've been seeing.
Precisely. The video mentioned that several big tech companies like Apple, Tesla, Nvidia, Alphabet, and Meta saw their stock prices drop due to these concerns.
And those companies rely heavily on global trade, so it makes sense that they'd be impacted.
Exactly. And it wasn't just China. The video also mentioned tariffs being imposed on Mexico and Canada earlier this year.
Right, in February and March of 2025.
Yeah, and that really added to the uncertainty because there were announcements and then postponements and then finally implementation. It was all very unpredictable.
And then Canada and China retaliated with their own tariffs.
Which further escalated the situation. It created this climate of absolute chaos and uncertainty in the markets.
And uncertainty is something investors really hate.
They do. They like predictability. They like to know what to expect.
And when things get too unpredictable, they start looking for safer assets.
Exactly. Things like gold or currencies like the Japanese yen, which are seen as safe havens.
And that actually caused the U.S. dollar to depreciate a bit.
Right, because when investors move away from the dollar and towards those safer assets, the demand for the dollar goes down and its value drops.
Okay, so we've got the yield curve flashing warning signs, and we've got trade wars creating chaos and uncertainty.
This goes a perfect storm.
Yeah, so now let's shift our focus to India, because the title of the video specifically asks if India is in trouble.
Yeah, how could all of this affect India?
Exactly. So the video pointed out that when the S&P 500 in the U.S. went down, the Indian Nifty 50 index also took a hit.
There's definitely a correlation there.
Yeah. But the bigger concern seems to be India's reliance on the U.S. market for certain key sectors.
Right. The U.S. is a major trading partner for India.
The video highlighted the IT services sector, where Indian companies like TCS, Infosys, and Wipro get something like 50% of their revenue from U.S. clients.
So if the U.S. economy slows down and businesses cut back on spending, that would directly impact those Indian companies.
And it's not just IT, pharmaceuticals, and textiles. We're also mentioned as industries that rely heavily on exports to the U.S.
Right. The U.S. is India's #1 export partner overall. So a slowdown there would affect all sorts of Indian industries.
The video specifically mentioned pharmaceutical companies like Dr. Reddy's and Sun Pharma.
Yeah, and textile manufacturing hubs in places like Surat and Ludhiana.
And then auto parts manufacturers as well.
A lot of sectors could be vulnerable.
Yeah, and the video brought up a pretty stark reminder of what happened during the 2008 financial crisis.
Oh, right when foreign investors pulled a ton of money out of India.
Yeah, something like 52,000 crore rupees was withdrawn from the Indian market, and the stock market crashed by about 60%.
That's a pretty dramatic example of what can happen.
Yeah, so is that a risk we could be facing again?
It's definitely a concern when the U.S. economy struggles. Investors tend to see emerging markets like India as riskier, and they might pull their money out and move it to safer havens.
So there's potential for another market crash?
The possibility is certainly there.
Okay, so the outlook isn't exactly rosy, but the video did offer some practical advice on how to protect yourself.
Right. It's not all doom and gloom. There are things you can do.
So what were some of those key takeaways?
Well, the first piece of advice was to really avoid taking on unnecessary expenses and getting bogged down by EMIs, those equated monthly installments for loans.
Right, so basically reduce your debt.
Exactly. The less debt you have, the more financial flexibility you'll have if things get tough.
And the second big piece of advice was to build up your emergency fund.
Right? Aim for 6 to 12 months worth of living expenses saved up.
That safety net could be crucial if you lose your job or face unexpected financial challenges.
It's always good advice, but especially important in uncertain times.
And what about major purchases like buying a house?
The video recommended against that during times of economic uncertainty.
Because property values could decline, and there's always the risk of job loss.
Right. It's not the best time to take on a big financial commitment.
And the last point they made, which I thought was really interesting, was about the importance of enhancing your skills,
Both hard skills and soft skills.
especially communication skills.
They argued that in a tough job market, people with in-demand skills are more likely to keep their jobs or find new ones.
And they specifically linked poor communication skills to a higher risk of being laid off.
Yeah, even if you're a great worker, if you can't communicate your ideas effectively, you might be overlooked.
So it's all about investing in yourself and your professional development.
It's a form of recession proofing.
So just to sum up for our listeners, we've seen how that inverted U.S. yield curve and those ongoing trade tensions are causing a lot of anxiety about a potential recession in the U.S.
Right, and how that could ripple out and impact India.
Yeah, through reduced demand for Indian exports and the possibility of capital flight.
It's all connected.
And we've talked about some steps you can take to try and weather this storm.
Reduce debt, build up savings, enhance your skills.
Exactly. And I think the key takeaway here is just how interconnected everything really is.
The bond market's trade policies, individual job prospects, it's all part of a complex global system.
Absolutely. So as we wrap up this deep dive, here's a final thought for you to chew on. Given how interconnected the global economy is, how might your individual financial decisions, even those small everyday choices, actually influence the trajectory of a potential recession, not just in the U.S., but also in a country like India?
It's food for thought.
Yeah, it really makes you think about the ripple effects of our actions.
It does.
So thanks for joining us for this deep dive. We'll keep you updated on all the latest economic developments. Stay tuned.
And until next time, remember, knowledge is power.
Absolutely.
Thanks for listening.
Bye.